Terehomikust, labrīt, labas rītas, and good morning. Welcome to the first meeting of the year to look at ECB decisions which were taken yesterday. I called this presentation one hand, the other hand approach because it was quote from Madame Lagarde press conference where they were discussing regarding risks on the upside and downside. But let's look at all topics one by one. Interest rates from central banks. I would say there are already a bunch of central banks who had meetings in January, and mostly rates are not changed, or actually major central banks haven't changed rates, so I would call that we started the year on a pause, and central banks are still in a good places to watch and follow developments of tariff impacts, of inflation, of employment market. Let's start with last week's Federal Reserve System meeting where rates were not changed, and of course a lot of discussions about next head of Federal Reserve and also interactions between Federal Reserve and President. Comment from Jerome Powell was that we are well positioned to address the risks that we face on both sides of our dual mandate. And of course, they are following unemployment levels and also inflation risks in US economy. And currently, they admit that risks are on both of those sides, they have diminished, which is pretty good news for general economy, which means that unemployment is still at reasonable levels and there is reduced pressure on inflation. And of course, there is also a high level of uncertainty. Comments regarding jobs, a lot of questions regarding artificial intelligence impact on job market. Will people lose jobs? Will there be a productivity increase and so on? But as Jerome Powell admitted that we don't really have those tools to address concerns, and they are still monitoring market very closely. But of course, investments in artificial intelligence, data centers and infrastructure are helping out a lot for economic growth. Only worry might be that it's too much, there's too big dependency on artificial intelligence related topics. Questions regarding tariffs were also addressed, and of course there is those tariffs are still in the background and there is still uncertainty regarding them, but as it was commented that tariffs were maybe lower levels than expected, they were changed, they were not passed through economy to consumption. But there is still a need to monitor the developments because I guess in December meeting, Jerome Powell told that in Q1 this year we might see the biggest impact from tariffs due to delayed nature of those tariffs in general. We need to talk about Kevin. That's a quote or name of the movie, one depressive movie, but I think it won't be that bad, and market received quite well news of a new potential candidate for heading Federal Reserve. Of course, there's still votings ahead, and it's not 100% guaranteed, but most likely that's the candidate who will win. And just asking perplexity about pros and cons and general attitude towards financial markets. There is a kind of bit dovishness into rate cuts, but no one expects that a new head of central bank will go for rate cuts immediately. There is also, based on his background, he criticized previously quantitative easing, that it was too big, too much. And of course, inflation, his inflation hawk might also keep rates where they are for time being. And actually looking at forecasts, there is not much expected regarding cuts going forward in United States. And of course, he's not alone who is making decisions. There is, if I recall correctly, 11, 12 voting members, and in a draw, he might be a decisive vote. But currently, if you look at voting, it's not like a close call towards decisions. It's widely supported the current stance of keeping rates steady. And also, yesterday during ECB meeting, journalists asked about Madame Lagarde regarding Kevin Walsh. Of course, not central banks don't comment such type of events, but Madame Lagarde is acquainted with Kevin Walsh because they were cooperating during financial crisis when she was the Minister of Finance in France. Dollar interest rates, long-term, short-term, comparing base rate with 10-year treasuries, there is still not nice development of those rates, because if you look closer, then base rate hasn't changed in January, but if you look at 10-year Treasury rates, they are a bit elevated, and this is a worrying sign because general economy and mortgage market in US, they need lower rates in order to boost growth in that segment. We'll see how it develops going further. That's the area. Hot topic, trade balance. Is there an impact from tariffs? Of course, there is impact from tariffs, but this reduction of negative trade balance is happening slowly. If you look at in a closer picture, what happened over the last couple of years, then, of course, due to that, I assume that October, this drop is related to shutdown in government, and there are still many data which central bank tries to gather due to that shutdown, and they are trying to get a correct picture. But if you look at top deficits, then, of course, China is not a top deficit regarding trade balance. Leader is Mexico, followed by Vietnam, Taiwan, and then just comes China with 14 billion trade deficit, according to November data. Moving to European Central Bank, yesterday's decisions, nothing was changed. So interest rate on marginal lending stays 2.4%, refinancing operations 2.15%, and deposit rate, which is very important for markets, stays at 2%. And also asset purchase programs are declining, and therefore no money is reinvested currently in a market. This is a long-term view of European Central Bank rates. So we are currently somewhere in the middle between 0 and 4% or close to 5%, which we had some time ago. And Central Bank currently is optimistic regarding developments in economy in general. A couple of quotes from yesterday's press conference. Of course, Central Bank admits that some risks have ticked up and some have ticked down, and that's why there was this headline of this presentation, one hand, another hand. So they are looking on both sides of the risks, and they have wide range of data which they are monitoring. But current conclusion is that we are in a broadly balanced situation. And regarding tariffs, it's kind of, I guess, characterized pretty well. It's up and down and out the back. And meaning that you can raise tariffs, you can reduce them, you can implement new ones, and you can cancel tariffs, and that's how the situation is still continues. Regarding inflation, there were questions regarding undershooting inflation. So we looked at January numbers, preliminary it's 1.7%, so below 2% target. And the central bank already forecasted last year that at some point inflation can undershoot, but as Lagarde reminded, we are at 2% in 2028. So there is still a long way to go in order to stick to the desired level, more or less, because inflation is still volatile anyways. Quotes, of course, underlying inflation has little changed in recent months, and central bank is monitoring closely wage developments, and also there were several questions during press conference regarding strong euro. And of course, stronger euro helps pressure inflation down, but this is not a recent development. It's regarding currencies, I will tell a bit later. This is chart of inflation data. It was interesting that in January document which was published in Estonia, it was marked C, confidential. Don't know why is that. But surprisingly big drop from November, December data in Lithuania and Latvia. So Lithuania 2.8%, Latvia 2.6%. And as we see, general in Europe, in Eurozone, average inflation is 1.7%. So we have positive trends also in Baltics finally. But of course, due to second pension pillar reform in Lithuania, there are worries about some upticks in inflation coming forward. Well, when people will receive money in account, will start to spend it in consumption. On interest rates, as it's monitored, the market rates have come down since last meeting, but not much. And of course, regarding lending surveys, there is still increased demand for lending and for loans. And of course, it's noticed that some standards for business lending have tightened again because of this higher uncertainty due to geopolitical reasons in the background. Market reaction was pretty muted. If you look at headlines, everyone noticed that there were discussions regarding undershooting inflation, regarding strong euro, and regarding artificial intelligence, but in general, nothing exceptional. If we look at long-term rates, then 5-year rate fluctuating between around 2.5%, a bit recovering. There was initially drop due to positive outlook of economy, but then rate went slightly back again. Currencies, euro dollar. Actually, euro went up before ECB announcement during the day, but then after announcement or during press conference, it came back to the levels it started the day yesterday. So no big changes overall. Assets. Central banks are continuing to reduce assets. If you look at the European Central Bank, of course, there is some uptick towards 6.3 trillion euros. It's also business as usual because we understand if economy grows, of course, central bank assets on a background, they grow generally over the time. But that part which was extra assets attributed to asset purchase programs and other supportive measures, of course, they are out of the balance sheet currently. In United States situation is the same. Then only thing what changed in December was that central bank is still purchasing treasuries because of preparing for April 15th, which is a tax date in United States. So that continues, but overall, of course, assets have gone down significantly since they were close to $9 trillion. Very interesting kind of topic for us, Euribors. Unfortunately, there are no good news for those who want to take a loan. Rates are not going down, and actually Euribor rates are all, except 1 month, all terms are about 2% level. And this is on the contrary good news for deposits. That means if you want to put the deposits, then those rates are not going down anymore as they were last year. Spreads are stubbornly high. If we compare 6 months Euribor versus 5-year rate, this spread has slightly increased and recently keeps stable. But that means market is pricing still that there will be no rate cuts going forward in a near term. And I guess everyone is just monitoring developments in market in general, how that will impact also interest rate environment. And this is a chart where we can just see how spread has changed between 5-year rate and 6 months Euribor. Currently, it's around 34 basis points and keeps that way. And of course, if you look historically, then I would say if you draw average, it's somewhere close to historical average if we ignore those spikes in 2022 and drop in 2024. Broken crystal ball, if we want to guess where 3 months Euribor will go for next year, we look at red line, and of course we can compare how market was pricing 3 months rate development. I put there blue line is 3 months ago and green line is half a year ago. What we can see in this picture is that actually in general market is more tilted towards upside, because if you look, green line was really showing that 3 months Euribor was priced going below 2%, and 3 months ago it was pretty flat, and now actually all forward curve is about 2%, which means market is cautious regarding further rate cuts and also not pricing rates going up, but something in between, like balanced view on interest rate future going nowhere technically. 5-year government bond yields in Eurozone, comparing Germany, Italy, Lithuania and France, what we can see is that if you look at the lowest rate, which is AAA Germany, it's tilting upwards slightly, but what we can monitor from higher, lower rating countries, this spread is diminishing because those rates are tilting downwards and Germany is tilting upwards. They are looking to meet at some point maybe, but most likely not. There will still be some spread due to risks and ratings. Money for corporates, and I use as a proxy corporate Eurozone corporate bond market, AAA, BBB companies, and compare it with Germany. On the left-hand side, you see that, yes, long-term rates are tilting upwards. But if you want to measure what's the risk price in those in the money currently, is we can look spread between Germany and AAA and BBB. We see that risk premiums versus Germany, they are going down slightly, but still going down if you look at the trend. But if you look at difference between AAA and BBB corporate bond yields, that distance is the same and has stabilized around 45, 44 basis points, not a big change currently. Currencies, euro dollar was a hot topic also yesterday because after this kind of around the Greenland topics, euro popped up to $1.2. But as Madame Lagarde commented, currency rate is not a kind of tool for central bank. Of course, they are monitoring it closely because a strong euro can pressure down inflation. But also, Madame Lagarde reminded that it's not like this start of the year when euro appreciated. The euro started to appreciate last year in March, and we can clearly see in the charts that after Liberation Day, euro rate went from 110 up to 115, and then now currently is living between $115 and $120 per euro. Swedish krona has appreciated from the start of the year. Currently, we are around 10.6 kronas per euro. If you look at British pound, same trend. Euro is slightly going down. Bank of England also didn't change interest rates, and it was a little bit of supportive towards British pound also. If we compare currencies percentage-wise in 2025, just looking still back at last year, we see that euro went up last year 13% versus dollar, 13% versus Japanese yen, was up 5% versus pound, which was bad for our exporters because those currencies we earned in those countries, they were depreciating. But what was supportive for exports was slightly Polish zloty, 1.5%, euro went down, and Swedish krona, where euro went down a bit more than 5%. If you look at the start of this year, 1 month is already kind of behind us, and 6 weeks in this year have passed. Then not a big change. We can see uptick in euro around those Davos meeting and Greenland questions, where euro was going like reached 2% higher levels than start of the year, but now it has taken all back, and we are close to zero change. Only visible changes are euro is down versus Swedish krona around 2%, and versus Norwegian krona around close to 4%, which is good for exports to those countries. Need to mention a little bit also crypto markets where people are losing money. Currently, there was a sharp drop from achieving records last year, and we are currently in this market at prices which last seen in around inauguration, around elections in United States. So those levels might be breached and market could go lower. I don't have any specific comments. They're just important part where also money is flowing currently out. Also, I guess whole technology sector is kind of closely also linked to crypto markets, and trends are similar in all those sectors currently. I like this quote from Hedgehog cartoon. My main problem is I'm uncertain how to deal with my uncertainty. I guess uncertainty is a word which figures in all central bank statements or at least comments. If you look at the unemployment market, which I follow closely because it's really important for general economy, do people have jobs? Is artificial intelligence cutting jobs or not? What we see actually is that the situation is really good in United States, and United States is biggest market and the largest economy globally, so that impacts all of us. And interestingly, that government is still struggling with gathering data, and January jobs, which usually are published first Friday of the month, meaning today, they are postponed, and January jobs will be published on February 11th. So we still need to wait for quality data in order to see how economy actually is performing. But this picture, which shows historic developments of unemployment in the United States, we are in a really good place, I would say, if we compare all previous slowdowns in economy or worries in economy. Unemployment 4.4% in December is a really good number. PMIs, or purchasing manager indexes, how services and manufacturing is going. And there's also good news if you look at indexes. If you look at indexes, then we see that there is actually a nice uptick in United States producer PMI, which went to 52.6, above 50, which is a growth area. And European Central Bank also is positive about service sector, but there is still issues in manufacturing. And but positive news that construction is picking up, and it might help general purchasing manager index going forward. So looking at those indexes, I would say we are also getting confirmations that economy is performing rather well. Comments about artificial intelligence I copied from press conferences, and if you look at the United States side, economy has surprised on a positive side. Central bank is positively surprised, and of course it's a lot of benefits from artificial intelligence build-outs. But one thing is that Central Bank doesn't have tools to measure all those impacts going forward from artificial intelligence, and they are closely monitoring therefore developments in that area. And Madame Lagarde also got questions regarding employment situation and negative impact potentially from artificial intelligence. But it was noticed that unemployment is almost at rock bottom in European Union or Eurozone, meaning that those levels are very low and close to the lowest level since euro implementation. But of course, productivity questions are on central bank agenda, and general impact on wages and employment is still monitored. Let's see, we will need to wait to understand the outcome. Indexes, we see those shooting rockets like Nasdaq reaching records also start of the year this year. S&P 500 actually during the day in January exceeded 7,000 mark, but haven't closed any day yet above 7,000, but fluctuating near there. And Euronext is also close to new records. And of course, we see this week was really interesting because we see that technology sector are going two different directions. If we compare as a proxy last week's result publishing from Microsoft and Meta, one went up 10%, one fell 10%. So what we are monitoring and seeing over the last years that certain companies are getting almost double-digit growth after result announcements, and certain companies are falling double-digit. And there is kind of moment of truth checking who is owning what how strong are balance sheets, how strong is capital spending, and who will overspend and who will gain from those developments. Again, quick look at last year. We see some really good performance. Hong Kong was leading 27%, followed by Nikkei 26% plus. And last place in this constellation was France with plus 10%. But currency impact, and therefore I draw also a chart where we add currencies. We know that the value of dollar fell some 11%, and then if you add dollar value and Japanese yen value, then last year leader is Germany plus 23%, then followed by Euro next 18%. And we see that Nasdaq and S&P 500 were actually achieving results poorer than French index. So currencies are very important topic if you look also on investment side. How this year started, first months, we see some positive trends in Nikkei, again plus 7%. Hong Kong is performing well. Which indexes are not performing well? This is this last week's drop in prices, specifically in Nasdaq quoted companies. After yesterday, I think index is even lower, close to minus 2% from start of the year, and S&P 500 is balancing around zero. So pretty nervous market currently if you look at prices. And is market really nervous? I'm using this VIX index. We see some upticks last year in October, in November, and last upticks this year where maybe something to look at was around Davos meeting, 20th of January, when index went to 20-point mark. But currently, even we see some huge drops in some company prices. On overall market is receiving it neutral. Those who are heavily involved in technologies maybe are really worrying, but those who are having like balanced portfolios and diversified portfolios, they of course suffering from technologies but gaining in other areas of economy. This is chart which I'm using regarding retreats to look at where is the buying opportunities, and what this chart tells you is that over the last 50 years we only have 7 times when S&P 500 index fell more than 20%, so we had 7 nice opportunities to have discounts or Black Fridays in order to buy cheap assets. Currently, we are really far from that mood in the market. Why I'm looking at those charts? Because after 3 fantastically good years, analysts, of course, are starting to look at, oh no, some crisis should come. But if we expand this chart and look at last 10 years, then we had only 2 drops below 20%. It was, of course, COVID and then 2022. Overall, market is pretty healthy, and all those retreats from record marks usually are used to buy additional assets. And of course, therefore, job market developments are very important, because as long as people have salaries, they are investing in funds, in pension funds, in investment funds, also buying equities, and there's no need to sell assets to improve cash flow. This is a really small table, but you can look at, I sent materials also to you can look more closely. This is a chart which shows like each end of the year where was index and what was previous 1 year, 5 year, 10 year, 15 year or 20 year performance, showing that actually we don't see too many negative years if you look at 1 year performance. We see also even rare 10-year negative periods, and they happen, of course, especially around big crises. But overall, market has never been negative after the Second World War. If we take market has never been negative if you look at 15, 20 or 25-year performance. So investing is a long-term game, and only future will show are those skeptics right or not regarding potential very weak next 10 years. I'm optimistic. Now moving to commodities, silver and gold were on top of headlines. About that a bit later. Let's start with diesel and gas, which I'm following up on a monthly basis. So diesel price is somewhat below $700 per ton, and gas after uptick towards 40 euros per megawatt hour has dropped a bit down to 34 euros per megawatt hour. Central Bank was mentioning that we need to monitor commodities and pressure on inflation. In general, if you look at larger scale commodities, it's not that kind of dangerous, and especially if oil, for example, is quoted in dollars and dollar is weak, so that means there is no big pressure from that part. And of course, if a price of gas jumps from 28, 29 to 35 euros per megawatt hour, it's of course is an impact, especially during heating season as it is now. Looking at charts year-over-the-year basis, if colored field is below 0, that means it's deflationary, and if chart goes above 0 and there is a lot of color above 0, that means we should be worried about potential inflation. But looking that way, Brent minus 9% comparing year-over-year currently, so there is deflationary pressure. As I mentioned, also diesel is pretty low comparing to historical numbers, minus 5% year-over-year if you look at yesterday's or this week's pricing. And even we saw some uptick in gas price. If you compare to the price of last year's February, it's minus 35%. So if you look year-on-year perspective, there is no inflationary pressure yet. Copper, very important ingredient for building artificial intelligence centers. Year-on-year price rising plus 40%. Of course, it makes all those investments more expensive. But if you look at steel, it's minus 3% year-over-year. Aluminium up 15% year-over-year. So in metals area, picture is not straightforward. There are upticks and also drops in prices, but of course, taking into account importance of copper and aluminium, it's of course inflationary pressure. Food part, favorite one, cacao, minus 65% comparing to last year's price. So we had huge price raise in 2024. End of 2023, early 2024. Currently, price is dropping down from those extreme high levels, which is good news for chocolate lovers. And Valentine's Day approaching, so we should expect nice price comparing to last year's increase. And coffee, also good news, but just last week, price is 19% below last year's price. But if you look at last year, starting from mid-2024 till end of last year, it was really inflationary, and coffee price at some point went up 100%. Now it's comparing to last year's February is minus 19%. And milling wheat, which is very important for food area, it's minus 17% year over year, so there is no significant food price inflation from that area. Dr. Copper, yes, price reached $13.7 per metric ton in London Metal Exchange. Now it's a bit retreated from those tops, but if you look at the trend from start of the last year, price was just going one way up. Only around Liberation Day there was some retreat, but overall price, there is a demand, there is a price pressure. Gold and times. Actually, gold during the day last week reached $5,500 per troy ounce, and then we saw a big drop. This is how price looks from 2022. We see that it was fluctuating around $2,000, and then at some point overshot 3,000, 4,000, went to 5,000. People start to talk about 6,000. But at some point you still need to support your cash flow, especially when there is a stress also in technology market. Cautious investors tend to sell assets and save cash flow and go to money rather than keeping it in gold or in equities. And of course, gold was mentioned in United States Central Bank meeting, and of course, Jerome Powell said that they don't take much message macroeconomically, but they are monitoring those events. And of course, gold is important ingredient in central bank balance sheets. The only problem is that if you have a constant amount of gold and price goes up, of course, your balance sheet value of the gold goes up. And when there is a drop, of course, that value goes down. But nevertheless, central banks were also seen as buyers in a gold market, especially after tariffs, after uncertainty in the United States. Large central banks started to shift a little bit maybe away from dollars and exchanging them from gold, which means maybe also lowering value of dollar. And when dollar price went down, also gold compensated that drop in dollar value. Silver reached 117 or even higher dollars per troy ounce, dropped significantly since last week to $78. And what to tell? Only difference between gold and silver, what is discussed in financial markets, that silver has real usage in manufacturing, and demand supposedly is higher than supply. That was the rationale why some analysts expected silver just go up. But let's say what goes high falls slow at some point also. I compared those two metals percentage-wise this year. Even we see a big drop last week and it continues this week, end of last week and continues this week. We are still above zero, so gold is somewhere 12% above start of the year and silver is 9%. But at some point last week of January, silver was 63% higher than at the start of the year. But I also, there is a mistake in heading of a chart, but I also made a picture for a longer period starting from last year's start. So if you look from January 2025, silver is currently around 170% above that price, and gold is somewhere, what we have, 65-75% above last year's start. So those investors are still in positive territory, but volatility is really high, and price moves are extreme in those areas. And of course, when investors need cash, they don't care which assets they have, they just exchange everything for cash. Do we have prerequisites for some big bubble burst? Maybe not, because again, if you look at the employment situation, a general economy, at comments from central banks, situation is rather good. This is a list of central bank meetings for 2026. We have a bit of challenge after April meeting, because April meeting is one day before holidays in Baltics, which is May 1st. We will think about how to move this event 1 week forward. But yes, 7 meetings to go for ECB and 7 meetings to go for United States. And United States, of course, Jerome Powell has 2 meetings left, and the new head of central bank, most likely Kevin Warsh, will step in from June meeting. That was it I wanted to tell regarding recent central bank meetings. I wish you good health, stable cash flow, and stay warm. Thank you for attending this event.